AMC Theater stock was the meme stock. If you look at the chart of AMC Theaters, it looks like a bloodbath. So after such a huge decline, let's think about whether it's overvalued, undervalued, and this is what this video is all about. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a membership website dedicated for microcap stocks hated and ignored by the investment community. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com. So make sure you get yourself a copy. AMC stock, like GameStop, was going to the moon. Investors sent the stock to unbelievable levels, but it's easy to look at the stock and say, oh, it's crazy, it's ridiculous. Of course, now it had a huge sell-off, but what does it mean? I want to talk to you about at the peak, when the market cap was 30 billion, and today the market cap is less than 10 billion. I want to show it to you in a logical way how crazy and ridiculous that valuation was based on what you were paying for a movie theater. Because AMC is a movie theater company. And in the business of movie theaters, what do you have? And AMC is pretty special to me actually, because AMC is a company that I had my first job. First job as a 18-year-old, I was working at AMC. They just built a new AMC and I got my job there, and I was a projectionist. So I was starting movies and it was cool. It was a cool job. So the company is special to me. But while I was there, I noticed how important it was for movie theaters, the concessions. It was always about the concessions. I wasn't doing the concessions because I was starting in movies, but there was so much emphasis put on concessions because that's how movie theaters make money. They don't make that much money on the movies itself because they have to pay high fees to Hollywood, but the movies serve to bring people in so that you can sell them overpriced popcorn and pop and all that. That's where the money is made. But it's a real estate play, right? You have to have a theater, you have to have all these seats, you play the movies so that you bring people in and you sell them the concessions. So at a valuation of 30 billion, which was the peak, how much were investors paying per theater? And how many theaters does AMC have? About 950. So let's call it 1,000 theaters, okay? If you take 30 billion divided by 1,000 theaters, what does it get you? It gets you 30 million. So investors were paying $30 million for one theater. And now that's not all of it, because you know from real estate that there's usually debt put on real estate. So if you're buying a $1 million apartment building and it has 800,000 of debt on it and 200,000 equity, you have to pay $1 million for it, and 200 goes to the equity and 800 goes to paying the mortgage. In case of AMC, they have about 5 billion of debt or corporate borrowing. So if we take 5 billion and divide it by 1,000 theaters, that gets us to 5 million per theater. So the equity, which was 30 billion, that's what you're paying for equity, and you have another 5 billion. So in other words, at the peak, investors were paying 35 million for a theater. And you might not have a concept of, is this a lot or is this not a lot? Well, I can tell you it doesn't cost 35 million to build a theater, okay? But let's look at the numbers, okay? AMC generated about 5 billion of revenues per year before the pandemic. And I want to use the before pandemic numbers. So if we take 5 billion divided by 1,000 theaters, we get about 5 million of revenue per theater. But it's a low margin business. So by looking at their financials, each theater makes about $600,000 per year, okay? And I'm already taking out the depreciation because, on the financials, they have the depreciation, so they really don't make that much money. But, people in real estate, they take out the depreciation. So I want to give them the benefit of the doubt, and I want to make those theaters be as profitable as possible. So I'm going to use the number 600,000, okay? If we take 600,000 and divide it by 35 million that the investors were paying for a theater, the return or cap rate that they were getting is 1.7%. So now think about this for a second. During the good years, before pandemic, a theater is making 600,000 a year, and you're gonna pay 35 million for it, and we are not even in good years. I mean, right now, those theaters are losing money, okay? And who knows for how long they're gonna be losing money. But now, let's say you're very optimistic, and let's say that you're like, COVID is gonna go away, it's gonna get resolved, people are gonna go back to theaters, and those theaters are gonna return to pre-pandemic profitability. Now, would you be buying a theater for 35 million? No, you would be like, I wanna get a deal, right? So I would say you probably would be like, okay, if during normal times the theater is generating 600,000 during normal times, maybe if you're super optimistic, you would pay maybe 5% cap rate. So you would take 600,000 divided by 5% cap rate. You would pay 12 million for a theater like this, if you're really optimistic, okay? And then you have to take the 5 million of debt that's on it, right? So for the equity, you would be paying 7 million, okay? During good years, 7 million. If you're the turnaround or you're taking a risk, would you pay 7 million for a theater right now? I don't think so. You would more likely be like, you know what? I'm gonna pay 2 million for that equity so that if I'm right, I can, 4x my money, right? They were paying 35 million. Of course, they didn't have this calculation in their head, but if you're paying 35 million for a theater during terrible times, just because you think it's gonna recover, I don't think it's gonna end very well for you. So now, the market cap is about 10 billion, okay? 10 billion plus the 5 of debt. So right now, even after the huge sell-off, they are paying 15 billion for the company in total. And how much are they paying per theater? 15 million per theater. So they're still overpaying because, again, during the good times, you would only pay maybe 12, including the debt. And now they're still paying 15. So even at today's level, the valuation doesn't make any sense, okay? So even at this today's level, they're overpaying for a very average business. So how do you think this is gonna turn out for them over the next, 3 to 5 years? Because if you take that 600,000 that I said before, 600,000 divided by 15 million, that's a return of 4%. But then again, that's when the theaters are actually producing 600,000. I don't think they're gonna produce 600,000 for many, many years. And that's a 4% return. Do you think if they knew that this was the kind of return they're getting, do you think they would be paying this much for the stock? Do you think this is enough return to take them to the moon? If I wanted to be optimistic and if I wanted to buy a theater and if I thought that they're going to return to 600,000 for the risk that you're taking, I would say I would need to get a 20%. So I would need to pay 3 million for the theater. But the problem is that there's already 5 million of debt on it. So in my view, the equity is worthless. I wouldn't pay a penny for the equity. But if I wanted to be very generous, and if I wanted to get 10% return on that, so 600,000 at 10%, I would pay 6 million for a theater. subtract 5 million of debt on it, and all I would be willing to pay is 1 million for the equity portion, right? So 1 million times 1,000 theaters, that's $1 billion. If I really was optimistic, I would price AMC at $1 billion. Today's valuation is about 10. So for me to get interested in a stock like this, it would have to fall another 90%. And I don't think I would even be interested at that point, because the opportunities that I have somewhere else are much better than buying a very poor, very average business, because this is not a high growth margin business. This is a very capital intensive business, because even though a theater can generate 600,000 of net income, a lot of that net income has to go for capital expenditures. And whatever is left for free cash flow, it's not that much. So over a long period of time, that kind of business will never generate you huge amounts of money. But if you're overpaying for it by a multiple of 10 times, it's 90% overvalued. Even right now, after it crashed so much, I don't think there's enough fuel there to take them to the moon. So we'll see. So let me know what you think about this calculation. I hope you enjoy this kind of content, and I will see you in the next video.